Welcome back to the Plan Your Federal Retirement Podcast. I'm your host, Micah Shalansky, and with me, as usual, is the amazing Tammy Flanagan. But in addition to the amazing Tammy Flanagan, Tammy was able to get someone from the TSP with us to answer some great questions. So special warm welcome to Kim Weaver, who is the Director of External Affairs at the Federal Retirement Thrift Investment Board. Kim, thanks for being here.
Thank you for having me.
Tammy, thanks for getting all this set up and having Kim join us and in that invite. I really appreciate it.
Yeah, I'm really happy that we could have her on board. I feel like we're very privileged to have this opportunity to hear some insider information from the thrift and to really get some questions with some straight answers. Because, we hear so much going around and so many people talk about the TSP that we want to be able to share some information that's very truthful and very upfront. So this is a great opportunity for our listeners.
Yeah, when we were kind of pre-gaming this, talking a little bit in advance, we were talking about how the TSP is a great part of the overall plan, right? Of a piece of the overall retirement that you have to look at. But it's a very important piece, and it's a bit of a unique piece in my mind because, and this is where I think some people make mistakes, and Kim, feel free to push back on me if you disagree, but people view it as, it's just like a 401k, it's just like an IRA. And while they have some of the same components, the TSP is quite unique for federal employees, and you really have to understand the rules and how you can best utilize that for your benefits. So I'm excited to talk about some of those questions.
Okie doke, can't wait.
All right, fantastic. Tammy, do you want to kick us off? Kim, before we start, anything else you want to add?
No, I agree with you. The TSP is, as has been said since it was created, as part of a three-legged stool. And you have to not only look at your three legs of the stool, but if you're married, your spouse's assets, everything has to come together for you to understand what your retirement plan is going to be. And that's the best, clearly, way to know what you're going to have in retirement.
Yeah, that's right. And I'll add two things to that little introduction. The first one is I heard this, within the last week or two, someone said that a lot of federal retirees can basically pay their bills using their FERS basic benefit, their Social Security benefit that might cover their living expenses, but it's the TSP that makes retirement worth living. It makes it so that you can take the trips, so that you can help the grandchildren, so you can live your life in a financial security than you would have had otherwise. So it's so important to have that because we don't ever want to have to say we're living on a fixed income or we can't go out to dinner because we don't have the extra funds. So the TSP really does make that possible. The other thing, now it slipped my mind what I wanted to say, but the other thing about the TSP is that it is part of that three-legged stool. And for some people, in fact, even remembering way back to when the FERS program first started in the 1980s, I remember seeing a diagram or something showing that you had the FERS basic benefit, the TSP, and then the Social Security benefit as kind of three equal parts. And we find out that they're not always three equal parts. In fact, for somebody who's working at a higher salary, their Social Security benefit could actually be a smaller replacement of their income because of the tilt to the Social Security formula. So I always impress upon our GS-13s, 14s, 15s, SES, how important it is to contribute as much as possible to their TSP account to kind of offset or counterbalance that tilt to the Social Security system. So I think that's another important factor that people need to keep in mind as they plan their retirement. Do you think that's true?
Oh, it's not only true, it's the way it was designed. Back in 1985, we have a blown up copy in our office of the Congressional Research Service estimates of and diagram of how for lower income participants, the more of their income is going to be replaced by the defined benefit and Social Security, and a smaller part by TSP, and the inverse for higher wage earners. That was the way the system was designed.
Mm-hmm. Yep. The theory was lower wage earners didn't have as much money left over to save. They were living paycheck to paycheck. But in theory, this is where the theory might fall apart for some of our higher wage earners, that there's money left over at the end of every 2 weeks to set aside for retirement. And that's the struggle some people have. But I think the numbers go to prove, Kim, that people are saving in the thrift. I mean, what is that balance we have in there today? Is it getting closer to $1 trillion yet?
No, not yet. It's what do we have as of July? We eight $814 billion assets under management, which is a nice chunk of change, I would say.
Yeah.
And our participants. The other thing is, I would say that it's important to know that almost 87% of FERS employees are contributing the full 5%, because what that means is they're not leaving free money on the table, right? And that's one of our educational points for any employee at any income level, is that if you can afford to contribute 5%, you're getting 5% back. You're literally doubling your retirement savings. And so it's a messaging point that we hit frequently. And the numbers show that it is, in fact, resonating.
Working. Yep.
And I like to add to that, it's not just free money you're leaving on the table. This is your benefits. It's your money, right? It's like not cashing a paycheck. So you got a paycheck out there and you're choosing not to cash it by not putting in that 5%. So yeah, I'm all about that. We don't give investment advice from a platform, right? Because everyone is different, except for, that's the one thing I'll just say constantly, everyone should be putting in at least 5%. We can have discussions after that, but yeah, you're doubling your money.
Yeah, it's a deferred 5% pay raise is the way I look at it.
Oh, that's a good way of putting it.
Yeah. Although we don't like that delayed gratification, so it's kind of hard to use that for a lot of people.
Yes.
But it is. It's money that's still there. It's your money. It's not like you're giving it to somebody. You're putting it in your TSP account. It's your bank account.
Right. And under the law, it's your account, right? We hold it in trust for participants. It is protected for each individual participant because it's their money.
Yeah, and I think the other thing to mention that some people misunderstand is that when you get money in your account, you're getting matching funds. That's yours 100% immediately. The only thing that has to be vested is what, Kim, the 1%?
Yeah, the agency 1% automatic. And that's 2 or 3 years, depending on which system you're in.
Okay, yeah.
I like it. Well, we were talking a little bit beforehand about distributions. And I know this is something Tammy and I kind of talk about a lot on the podcast is, we talk about cash flow, knowing where your money's going to come from, what your net benefits is always something good to chat about. But Kim, let's just kind of talk a little bit about the distribution options beforehand. So what's the most, and just because we're going to talk about the most favorite or the use the most doesn't mean it's right for everybody, right?
Exactly.
But for you, from what you guys see from the TSP office, what do you guys see as kind of the most frequent distribution option?
The most frequent distribution option, hands down, are monthly payments, which means you come and you say, there are 2 ways of doing it. You come and you say, I want you to use the IRS chart. It's not the words you're going to be using to us, but you give us payments based on our life expectancy. And then we use the IRS actuarial chart and we recalculate that each year. As you get older, your balance fluctuates and we adjust those life expectancy payments. That's one way to set up monthly payments. The other way is for you to say, we were also talking before the show that this is your money to have. You don't want to be not able to go out and have dinner, so splurge a little. So you can say, I want $500 a month, I want $1,000 a month, whatever you believe is what you need. And one of the things that I think is really misunderstood, and I want to be really clear about, is if somebody is taking a monthly withdrawal and $1,000 a month, and so we're going to send you $12,000 that year. If you happen to be of an age where you would have to get a required minimum distribution, we will send you that additional money in December so that you are not penalized. You don't have to worry at the end of the year that you need to make an additional withdrawal to make up that money. We will affirmatively do that, which is different from a lot of IRAs and 401ks.
Mm-hmm.
So Kim, what I heard, so for an example on this, let's say that you're taking out, again, that 12,000 a year, but your RMD, that required minimum distribution. So now it's changed, right? If you're over 73 and you have this RMD requirement, and let's say it's $18,000, just for easy math. So they're getting $1,000 a month as a gross distribution in December. Is that two different deposits you're going to give them? Are you going to give them the $1,000 a month plus the extra 6,000, or how does that work?
Two different deposits, because they're processed as two different transactions.
Perfect. That makes tons of sense. So then you're still going to meet that RMD. So if you're doing monthly withdrawals, whether it's life expectancy, that's already calculating RMD in there, or if you're just doing a fixed dollar payment, you guys are going to make sure that RMD gets processed. Now, one of the benefits on waiting on an RMD towards the end of the year, pro and con with this, is sometimes Congress changes their mind and says, you don't have to have an RMD this year, right? We saw that during COVID.
Yes, we
and
did.
so I'd imagine,
yes, we did.
right? And we saw it a few years before that too, is that the RMD was 5-6 years before that. But anyways, RMDs were suspended for a year and you don't have to take them. So that is a nice benefit of doing the distributions that way.
Yes.
Yeah, rather than splitting up completely evenly throughout the year.
Yeah, if you split it up evenly, so people that got caught up in COVID, right? If you would have said 18,000 a year, so 1,500 a month would have been coming out. And then Congress comes in and says, great news, you don't have to take your RMD. Well, you've already taken some money out. You're limited in your rollovers and what you can put back in. It's not as simple as that.
Kim, whenever you send monthly payments to participants when they're making those withdrawals, do they get a statement every month? Somebody had told me they get a statement.
They get
in
a
the mail.
notification, not a statement, but they get a notification that the deposit
That it was
was
sent.
made. And we are well aware that some participants don't want that via the mail. They'd rather have it by email. And we're working on that. But at the moment, it is still a paper notification that the deposit was made.
That's good to know. Good to know.
Yeah.
So you also offer quarterly payments and an annual payment.
Mm-hmm.
So if they wanted to, for whatever reason, maybe there's a bill that they pay once a year, could they do a once a year annual payment as well as monthly payments? Can they have two different distributions at the same time?
You can, so yes, kind of is the answer, because you have to you can't have two withdrawals within a 30-day period. So
Okay.
let's say you on January 1st, you make your annual withdrawal of $25,000. And then you think, I really want monthly payments as well. You'd have to wait 30 days, come in and set the monthly payments up and go forward, or vice versa. It doesn't matter the order. What matters is the time frame in between. And we did that not really to limit people in their ability to use their money. We did that to ensure processing times and the streams don't cross, because then, things can get mixed up and we don't want that.
Kim, a really detailed question on that. So forgive me if you don't know the answer, but is it 30 days from when you submit the request or 30 days from when the distribution went out?
I don't.
So if I log in, so if I log in on the 1st, just making things up, I log in on the 1st and request it, but the distribution doesn't go out to the 5th, again, just making up dates. I'm just curious how precise that is.
I believe it is from when you request it, but I would not put my hand on a stack of Bibles.
Okay. We'll keep the Bibles off to the side for now.
There we go.
Perfect. Well, I know as we're talking about distribution options, one of the things we were talking about before, which would be really great to keep in mind, is irreversible decisions. So one of the nice things under the TSP Modernization Act, right, is a lot more flexibility. We have a lot more withdrawal options, which is fantastic. But there's still a couple of irreversible decisions, which, again, this is a great time to mean irreversible does not mean bad, but it does mean you cannot fix it. So there's a giant red flag to hit a pause button and say, hey, do we really know what this means? And are you making the right decision? So Kim, what are those irreversible things with the TSP?
There are really two, Micah. One is if you purchase an annuity through the TSP, you purchase it with our vendor. So what we do is we take that money out of your account and you can use all or a portion of your account to purchase an annuity. But absent an error on our part, that decision is irrevocable, irreversible, done deal. And so that is something that is very important, because on occasion, there are people who believe an annuity and monthly payments are the same thing, and they most emphatically are not the same thing. So I
Right.
completely agree with you that anytime you see the word irrevocable, you should stop. And if you need to, feel free to call the thrift line. And, a PSR will walk you, our participant support reps will help you and walk you through the options and what the various options mean. The other one that is again, irrevocable, is if you roll your entire balance out and you zero it out, you can't bring the money back. We'd love to have you, but you can't bring the money back. So if you are planning on rolling some or all of, if you're planning on rolling the bulk of your money out, it's wise to leave. The minimum is 200, but you can fall below 200 because of the vagaries of the market. I always sort of recommend a slightly higher amount, not thousands and thousands, but just to make sure that you don't fall below 200, and then we would automatically close that account.
Yeah, those
Kim,
are important to know.
Yeah, I recommend that same thing. If people are going to do a partial transfer out, and I like thousands, right? Because I like rounding up with that, is like, no, let's make it a healthy balance in there. So maybe it doesn't need to be six figures, but let's not worry about it because you're leaving that foot in the door. And whenever I'm talking to people about, well, what do you mean I can't put my money back in the TSP if I take it out? And I'm always saying, well, pause. I guess what you could do is you could go back to work for the federal government and you could get another job and open up a TSP account. But all of a sudden, retirees don't find that as a very appealing option anymore for some reason. So leaving that balance in the TSP is a great way to put that foot in the door.
Yes, it certainly is. And it's just preserving your options, right? People, again, retirement and retirement choices can really be overwhelming. And so it is not hard to make a choice and then think, this is not what I wanted to do. And if you have taken all your money out, well, that's, unfortunate. But if you've left $500, $1,000 in the TSP, then you
Right.
can roll your money back in.
Yep. Or even if you get a second career and you have a 401k plan, if that TSP account's open and you want to move that money into the thrift, you would still have the option to do it.
Absolutely. And we now offer a roll-in concierge service. So if you want to roll money into the TSP, you can call the thrift line and ask to be connected to the roll-in help desk, and they will help you because, as I'm sure you both know, the paperwork to move money between plans is not necessarily the easiest process in the world, and that's simply you're moving tax. Most of the time, it's because you're moving tax advantaged money, and so both the losing plan and the gaining plan have to make sure that all sorts of rules are followed. And so the concierge service helps with that process.
Well, that's good to know. I didn't even know that.
No, I think that's fantastic because, like I say, one of the things that if I look at some of the biggest mistakes I've seen with the TSP, is people not understanding transfers versus rollovers. And this would be another way that just easily comes in is people say, oh, I'm just going to put my money in the TSP, and they just take a withdrawal from their 401k plan. And then their planning is just to put that back in the TSP. It's like, ooh, that does not work that way. That comes with a lot of complications and potential taxes and issues that's there.
Yes.
So these are things that you could go from a great decision to an irreversible tax problem really, really quickly right here.
Very quickly.
So the fact that you, so way too quickly. So the fact that you guys have this roll-in help desk, that is great. And this is the one that we got to maybe swallow our pride or get more information, even though we think we know how it is. It's worth picking up the phone and chatting with somebody and saying, hey, let's make sure. And if they disagree, okay, great. Maybe you need to talk to somebody else, right? But make sure you know the right answer before you pull the trigger.
Yes.
Sorry, I get on my soapbox on that.
Yeah, no, and it's very true. All of these things, when you're dealing with tax advantaged money, regardless of where it's sitting, there are IRS rules that attach and are relatively unforgiving in the overall scheme of things. And so you want to make sure you know what you're doing before you get that money out of that account.
Hey, Kim, whenever somebody leaves federal service, whether they're resigning or retiring and now they have access to the money in the thrift, could you walk us through like some of the things one would do in order to make those elections? Like, do they fill out a form? Do they call the thrift line? Do they go online?
Well,
Or
first of
what is the
all, if
process?
you separate from government, you are more than welcome to leave your money with the TSP. There is no
Right.
need to take your money out. You can let it grow. And in fact, as you said earlier, if you have other private sector 401ks or other plans that are meet the tax requirements, you can roll that money into the TSP and consolidate your retirement savings.
Right.
But should you want to roll it out, should you want to make a withdrawal, you can log into your TSP My account. And if you're married, you can do the entire transaction online. You'll fill out the form online. And then your spouse will get an email to provide his or her consent. And then we will process the withdrawal. I would say to our earlier point about irrevocable decisions, if you're going through that form online and you think, I wonder what this means, give us a call. We have operators standing by. So
Right. Don't check it to find it out later. Pick up the phone and call first. Yes, I
before
like
you
that.
hit the submit button, please give us a call. And if for whatever reason you don't have access to a computer, you don't want to do it online, you can call the thrift line. They will mail you a TSP 99 or one of our withdrawal forms. It depends on your transaction. But it'll be coded to you specifically. And that is an anti-fraud measure that we put in several years ago. It just makes sure that withdrawal forms are easier to process once we get them back, and B, less prone to mischief.
And what about when a participant passes away and a beneficiary, let's say it's not even the spouse beneficiary, it's someone else, how do they contact the thrift? Do they go online to report the death, or is there a form they fill out? What do they
Just
do?
give us a call. Do you notice the theme here? Give us a call. And there is a form whose name I am now blanking on, but basically what you do is you provide the TSP with the report of the participant's death. If you have access to it, a copy of the death certificate. But that gets the ball rolling, and we would then look at that participant's file, see if there's a beneficiary designation on file, and just start the process of processing the death benefit.
And those beneficiaries, they have the option of either taking the payment in cash and probably paying tax on it if it's in the pre-tax account, or possibly transferring that into an inherited IRA from that account as well.
Yes.
So again, important to ask questions, because if you take the payment, and Micah might know this as well, can that still be transferred to an inherited IRA? No.
No,
So
once
you have to have it go
distributions,
directly.
yeah, you can't do rollovers on or transfers on. You can't do rollovers on any inherited money that comes out, including with spouses. And this gets a little tricky. And so really one of the things, I love the TSPs there. I'm also going to encourage, before you take a withdrawal, any death account, talk with a tax advisor. Because these have different, Kim, as you brought up, these have different types of tax consequences that can be there. And the TSP, I'm not overstating this, the TSP is not set up to give tax advice on how this is going to set up for inheritances, right?
Nope.
So you got to get both of these. You got to know how the TSP works from distributions, which is fantastic. Then you got to get someone before you pull the trigger that knows what it is. I'm just dealing with an estate right now, and my client's getting money. And unfortunately, the executor just pulled all the money out of retirement accounts to send it to the benefit. Yeah, that face right there is the same one I made. And they were like, well, I talked to the estate attorney and they said there's no estate taxes. True, but there's ordinary income taxes. And so now there's a big tax bill that has to be paid. Ooh. That I get to be the bearer of the bad news. So maybe I'm just being selfish here. I want someone else to be the bearer of bad news. But you got to know how the distributions work and the tax consequences at the same time before you do it.
Well, and especially with IRAs, because and inherited IRAs, because the tax rules have changed, right? The stretch IRAs no longer exist. Now you have to
Right.
take your money out in 10 years. There was some initial confusion over what that really meant. So, again, we are not in any way, shape, or form set up to give tax advice. That's not our mission at all. But we do encourage people to understand the ramifications of what they're doing.
Yeah, sometimes I tell people when they file their beneficiary form to file that death benefits publication with it, because people don't know what they're. I just
Yeah.
talked to a guy who lost his son. He was 50, an older man. He lost his 56-year-old son, who was a federal employee, and he just took the distribution, not knowing like what all he could do with it. So yeah, it's important for them because sometimes you've never inherited money like that, and this can be a ton of money in some of these
It
TSP
certainly can.
accounts.
Yeah.
And also the other thing that we don't think we give enough credence to on the death side of it is it's emotional, right?
Yeah.
You're generally an executor or personal representative because you were close family. That's generally who people pick, is a close family member to do this. Then in this case, right, you lose your kid. That has a massive emotional effect. Even if you know these things, you could still not be making good decisions because of that emotional effect that's there. Yeah.
Absolutely.
That's for sure. Yeah.
You know, it is horrifically tough. I mean, that would be just everyone's worst nightmare. And again, you're trying to make decisions you may not fully comprehend, or you're just so upset
Just trying
that
to get it over with.
you're just trying to get through it. And so I completely concur that consulting a tax advisor or someone who has some experience in this area is definitely.
If there's not an urgency, right? You don't have to hurry up and get it out of there. It'll stay there, or what happens?
Well, once we transfer it to a beneficiary account, if it's a spousal beneficiary account, there's no urgency. But if Micah is your beneficiary, Tammy, and God forbid something happens, we would, and you're not related, we would we would create a temporary account for Micah's benefit. He would have 90 days in which to make a choice about that money. And if he doesn't roll it out into an inherited IRA or some other an account, we will auto force out a check. And that does, in fact, have.
What happened? That was, I kind of heard the backstory on that one, and that's probably why the father was so upset, because the money came out before he knew what to do with it. Right.
And that's why. But again, we do. I mean, it's not like we keep it a secret and then we just send people big checks. We send notices. But again, to Micah's point, in that situation, when you're dealing with the death of a loved one, reading notices from the TSP or any other financial institution is probably not at the top of your list.
Not on the top of your list. That's right.
No. So on that, is it 90 days from the date of death, or is it 90 days from when the account is created?
90 days from when the account is created.
Gotcha. Okay, so there's a little bit more wiggle time, right? So this would be making sure before you submit forms, before you do anything, what's the overall plan that you want to do when you address it? Okay, that's a really good point, Kim. Thank you for bringing that up.
You're welcome.
So we talked about the TSP withdrawals, getting off of the death theme, if I may. Let's talk about timelines real quick. So one of the things that I always encouraged people about is say, hey, your TSP is not a bank account, right? This isn't going down to your bank and taking money out whenever you like. Number one, there's investments, there's tax consequences, but there's also a timeline that's here. So Kim, what's the general timeline from when somebody wants to take money out and they go to process it online for when they actually receive the money?
So it depends on the course. It's like if A, then B, right?
Sure.
So if you have a current financial institution on file with us, then and that's where you want your money to go, then you could, again, go online and you could do that transaction. And again, spousal, non-spousal, depends on what it is. We would get that. Let's say that happens, the spouse, it all happens in a day, let's say. And that can happen.
Sure.
that night we would probably have gotten it in the afternoon, right? I'm making up a whole bunch of hypotheticals.
Yeah, that's fine.
They're
That's
making
fine.
it
Yeah.
in the afternoon. So the next day would be the day that we would then tell BlackRock at the end of the day, you need, or State Street, our fund managers, you need to sell X in order to fulfill this, right? So they do that trade overnight. That money comes back to a treasury / TSP account, a big one, not individuals. And then the treasury, at the same time that money comes back, we tell the treasury where to send it. So if it's a check, it'll be mailed. If it's an EFT, it'll be electronically sent through the ACH process. So a lot of people forget about the fact that we're not a bank. We don't have money. So we don't have sort of a money market fund sitting around where we can just pull money from Micah and send it to him. We actually have to sell the shares that are being invested on that participant's behalf, and that takes time. And so again, let's say it's a Friday afternoon and we get it Friday afternoon. Well, that sale then isn't going to happen until
Monday.
Tuesday, because we don't send that transaction, right? We don't notify. So that's the process. And people do get upset thinking that we're somehow holding on to their money. But it's just, again, we don't have the money. It's invested on your behalf.
Yeah.
I mean, I don't want to scare anybody. We have the money, but we don't have cash. We don't have cash laying around.
It's not sitting there in your office.
And so that was based on the premise you already have financial information on file with us. If you don't,
that was the key thing you said about making sure you have that banking information. You can set that up without making a withdrawal, right? You can just
absolutely. And to the extent that, like, you're starting to, let's say you even have a hint of a thought, I might need a loan or I might need a withdrawal. Go into your TSP My account or call us and have us put the financial information on file, because it has to be on file for a full 7 days before we will process a withdrawal. And that is done as an anti-fraud measure in large part. That gives us time to contact the participant and say, hey, this account was put on your, on your TSP account. Was that you? And, it's almost always you, but every once in a while there's a bad actor in the world. And so
let's make sure.
That's why we do it. It's not that we have an attachment to your money. It's that we are trying to protect it.
Right. Now, you can choose to take money from the traditional side and leave your Roth money alone, right? Under the Secure Act, we're allowed to pick and choose or take pro rata if that's your choice.
Yes.
But we can't pick and choose, like if we're invested 50% G and 50% C, and we're taking out $1,000, we can't tell you to take it just out of our G fund, right?
No, you can't. You can, of course, rebalance immediately afterwards, but you can't tell us which fund to take
that would
it
be
out.
the way to solve it, is just to then go in there and fix your account.
Right.
So, Kim, I just want to go back to a timeline, if I may. So if I wrote this down right, so we have I'm going to say the trade date plus 2 days, right? So if it's a Friday, then it was a Tuesday that the money's going to be available. So if you have a financial institution, and then plus then after that, you'd have to do, let's assume it's electronic transfer, then maybe it's 2 to 3 days for the electronic transfer to go through, right?
Well,
every bank can be a little different.
What I found once I started this job, you learn all sorts of fun stuff in a new job. What I didn't know was that banks, depending on their size and the number of what they get from the Treasury, sometimes they only pull it and credit it once a day. Other times it's a major institution and they're crediting it all the time. So I have seen it happen where it's you get it, you put in your request, trade, and you've got it in 2 days, right?
Yes.
That's sort of if if you did it in the morning and you have it online and
Right.
that particular
There's
bank
thousands there.
pulls it regularly and credits the account, it can happen in 2 days. I think 3 to 4 days is a far
Realistic.
more likely
Yeah.
scenario. And again, it has been longer, but it's because the bank hasn't credited the account, which I didn't know that happened.
Yeah, it's all, again, a manpower size, right? They're all different on how they do that.
Yep.
So I would be planning at least a week if you need money in advance. And if you don't have a financial institution set up, then really you're talking 2 weeks, maybe 2.5 weeks, that if you're ahead of it, right, and you're getting the money in advance, then it's no problem. The only problem that comes up, there are people that are frustrated, is when they thought they could get their money sooner.
Right.
So you got to be thinking, and I'm not picking on the TSB, I'm going to say any investment institution, the same working blocks you talked about work across the board. It's slightly different levers, but it's the same thing. If your money's invested, it has to be sold, has to be freed up, has to be transferred, right? All of those things happen. And so any type of investment account, you should be thinking a week plus in advance before you want money out and get that process started.
Absolutely. And again, if you are thinking, as I said, if you just have a glimmer that whether it's because you have a hardship and you need money, or you need a loan because your hot water heater just blew up, any of those things, if you think that that's something, go in and put your financial institution information online, because so what happens if you don't? Well, you have an option of having us mail a check to you, right? And so the timeline we just described becomes longer because you still have the front portion, and then the Treasury mails the check out. And that is subject to the vagaries of the Postal Service.
I live in Alaska, so I tell people it takes 2 weeks to get a check from the Treasury Department.
Yes.
So that's about 10 days to 14 days is about what we see for our clients. Yeah. Okay. On distributions, I know we're going a little bit long, but had a quick question on international transfers. So some clients at TSP participants, they have a great career. They want to move overseas. And just because you move overseas doesn't mean you have to get rid of your TSP. However, there's a little there's some rules around how you can take money out, right?
Right. The Postal Service, because again, Treasury is acting as our bank. They're sending out the checks. They will only send that money to a U.S. financial institution. And so if you're moving overseas, you should set up, you should maintain a U.S. Bank, and then you can work to find a bank wherever you are that can link those two accounts. But we're not able to send the money overseas, wherever that is, at least not electronically. Again, if you want to request a check, we can mail a check, but then you're talking international mail. And there's even more vagaries because it's multiple postal services then involved.
Jeez. Yeah,
So-
we never think of those little details when we're making this wonderful dream of moving to Tahiti.
Right. Exactly right.
A lot of little housekeeping things you got to think about when you're going to live abroad and live internationally. I have a couple clients doing it right now, so it's kind of top of mind. But it's one of these things that thinking about in advance and starting to walk through that process is always so more advantageous. Just like if you want a distribution, Kim, to your point, if you got that inkling, put your financial institution in there. Well, what if you don't need the distribution? Well, then you don't pull the money out, but it's just fine. It doesn't cost anything. There's no downside to doing it. So getting in ahead of these things is really, really important.
Yes.
Well, Kim, this podcast is all about action items for our listeners. We love to chit chat and to go through things. Then we love to kind of talk about that. What are things that our listeners could be doing this week in order to improve their understanding of the TSP, to improve their understanding on retirement? So I won't put you on the spot. I'll go ahead and kick it off, and I'll say number one thing that you should do is figure out exactly what your withdrawal option, what you think it is, and then contact the TSP and find out how it really works. So if you think you want to do an annuity, if you think you want to do monthly payments, if you think you want to do lump sum, whatever you think that is, write that down, then call up the TSP office and find out how they say these distribution options work, because it's before you need it.
Yeah. I would say to make sure your beneficiary designation is up to date. Before you leave federal service, make sure your address is current with the TSP, because whenever there's mailings, you don't want to have that mail forwarded, within a couple of weeks. You want it when it's sent. So things like that. And if you are separated, get that bank account on record. So when you do need the money, that's not going to delay your withdrawal. Those would be my suggestions.
That would be excellent suggestions. And I would say you can go to tsp.gov and search for online learning. And we have a bunch of webinars that are available. You can watch. They're also recorded. So, you can get some popcorn, sit back in the afternoon, and you can watch some of the TSP webinars. But I think it's an excellent way. Our trainers are wonderful. They know more about the TSP than anybody. And so they can really help explain, or even if you know like 98% of it, there might be that little nugget that you think, oh, I didn't know that. And so I would highly recommend those as well.
I endorse them as well. I've listened to a few of them, and they've been very, very well done.
Fantastic. That is great information. Well, as always, Tammy, it's great to have you on the podcast. Thank you so much. Kim, thank you for taking the time out of your day and joining us and helping educate more of our listeners. I know they appreciate it, and so do we. And until next time.
Thank you so much.